everybody, my name is Lorenzo and this is Crypto with Lorenzo. In this video I want to bring you to see the difference between yield farming, stacking and liquidity pool, which are three of the best passive income sources in the crypto world. So let's go and dive in and see what is liquidity, what is stacking, what is yield farming, and which one is better suited for you, for what you would like to do, and which one has the best results but also the worst risk you need to take. So without anything else to say, please make sure you leave a like, subscribe to the channel if you like this video, and share with all your friends so that they also know what they were gonna do. So let's jump straight into the video, guys. And as we can see from the laptop, it says that yield farming is the practice of stacking or lending crypto assets in order to generate high returns or rewards in the form of additional cryptocurrency. This innovative yet risky and volatile application of decentralized finance, DeFi, has skyrocketed in popularity recently thanks to further innovation like liquidity mining. Yield farming is currently the biggest growth driver of the still nascent DeFi sector, helping it to balloon from a market cap of 50 million to 10 billion in 2020. In short, yield farming protocols incentivize liquidity providers, LP, to stake or lock up their crypto asset in a smart contract-based liquidity pool. These incentives can be a percentage of transaction fees, interest from lenders, or a governance token, see liquidity mining below. These returns have expressed as an annual percentual yield, APY. As more investors add funds to the related liquidity pool, the value of the issue return decreases accordingly. So the more money you put in, the less percentage, because it needs to be split by the people that are working on this yield farming. The more money there are, the less APY there is. If a crypto, let's say, has $1 million in liquidity and has an APY of 1000%, if this crypto grows and the news about this liquidity mining or yield farming or stacking goes around, the price of the, let's say, the volume of this crypto will go from 1 million to 10 million. Therefore, the APYs will also go down from 1000% to 100%, but still crazy numbers compared to what the bank, for example, gives you. At first, most yield farmers stacked well-known stablecoin USDT, DAI, or USDC. However, the most popular DeFi protocols now operate on the Ethereum network and offer governance token for so-called liquidity mining. Tokens are farming these liquidity pools in exchange for providing liquidity to decentralized exchange. Liquidity mining occurs when a yield farming participant earns tokens reward as additional compensation and came to prominence after Compound started issuing the skyrocketing Comp, its governance token, to its platform user. Most yield farming protocols now reward liquidity providers with governance token, which can usually be traded on both centralized exchanges like Binance and decentralized exchanges like Uniswap. But this is a little bit the, let's say, the recap and a little bit of a preview what yield farming is, and this is taken by coinmarketcap.com website itself, so it's a secure way to learn and to see what we have here. What is APY in yield farming? Yield farms, and most protocols and platforms, calculate the estimate returns in terms of annual percentage yield, APY. APY is the rate of return gained over the course of a year on a specific investment. Compounding interest, which is computed on a regular basis and applied to the amount, is factored into the APY. Since the DeFi summer of 2020, yield farmers have been chasing eye-opening 1000% APYs. However, these protocols and coins may be highly risky and substantial to rug pull. What is a rug pull? A rug pull is when you go and you do such a yield farming like this on a small coin that offers like 10,000% APYs, and then once your money is tucked in and the creator of these coins are like, okay, there are a lot of money involved, let's unplug everything. So they disconnect everything, they cancel everything, and they run away with your money, and therefore you lose all of your monies because the coins goes completely to zero. You can get 10,000 APYs, but there's no more coins, so you're getting 10,000 of nothing. And this is why it's called a rug pull, because they just pull out of this method. Furthermore, the yield is earned in the form of protocol tokens and is subject to highly volatile price swings. The 10 most popular yield farming protocols. So we saw what a yield farming is. It's basically an APY, and it's when you give liquidity and so on to the mechanism. So the 10 most popular yield farming protocols are AAVE is an open source non-custodial decentralized lending and borrowing platform to create money markets. where user can borrow assets and earn compound interest for lending in the form of AAVE token. It has the highest TVL locked among the DeFi protocols, sitting at over 21 billion as of August 2021, and it has a 15% APR. So this is not bad actually as an APR. It's a very fair and it's a good APR in my opinion. Compound is a money market for lending and borrowing asset, where algorithmically adjusted compound interest rate as well as the governance token COMP can be earned. It is audited and reviewed to ensure the highest level of security standard. Total supply is over 16 billion as of August 2021, and the APY range from 0.21 to 3%, so it's a little bit lower. Then we have Curve Finance. We got Uniswap. Uniswap is very good. It's one of the biggest, so you should go and look into it even more. InstaDAP, SushiSwap, PancakeSwap. PancakeSwap is also very nice. It's a DEX built on the Binance Smart Chain network for swapping BEP20 tokens. PancakeSwap uses an automated market maker model where users trade against a liquidity pool. It has the highest TVL among BSC protocols, with over 4.9 billion locked as of August 2021. It focused heavily on gamification feature with lottery, team battles, and NFTs collectible. APYs can go as high as 400%, and the PancakeSwap automated is something crazy and has a 70% at time of recording APYs in your investment if you lock the PancakeSwap token, which is a very safe token to do. Then we have Venus Protocol, Balancer. Years.finance is an automated decentralized aggregation protocol that allows yield farmers to use various lending protocols. Then we have a section yield farming for Bitcoin. As far as crypto farming goes, most users would ask if there is a yield farming for Bitcoin. While there are no DeFi yield farming protocols for Bitcoin, Wrapped Bitcoin effectively brings Bitcoin into the Ethereum blockchain and DeFi application. By learning how to wrap Bitcoin, holders of Bitcoin can earn a few percent of yield while lending it out on protocols such as Compound. Then we have CoinMarketCap yield farming rankings. So this is if you would like to know a little bit more what CoinMarketCap and yield farming rankings are and so on. And then the risk of yield farming, of course, let's go and look. The yield farming can be increasingly complex and carries significant financial risk for both borrowers and lenders. It is usually subject to high Ethereum gas fees, this is the downside, and only worthwhile if thousands of dollars are provided as capital. Users also run further risk of impermanent loss and price slippage when markets are volatile. CoinMarketCap has a yield farming ranking page, which has an implemented loss to help discover, so this is something that you can go. And then they give you the example and what else you need to know. Let's go now, after we saw the yield farming protocols, so let's go and look at what is crypto stacking. This is the best crypto, let's say, passive income, in my opinion, crypto stacking. So crypto stacking is similar to depositing money in a bank in that an investor locks up their asset and in exchange earns rewards or interest. Stacking is a term used to refer to the delegation of a certain number of tokens to the governance model of the blockchain and thus locking them out of circulation for a specific length of time. A popular network's protocol locked up an investor's holdings, similar to depositing money in the bank and agreeing not to withdraw it for a set period of time, which benefits the network in a couple of ways. First, this can increase the value of a token by limiting the supply. Second, the tokens can be used to govern the blockchain if the network uses a proof-of-stake system. A proof-of-stake system, as opposed to a proof-of-work one, which incorporates mining, can be fairly complicated, especially for crypto newcomer. In the proof-of-stake system, coins are stacked to forge new blocks in the blockchain, for which participants are rewarded. Winners are selected through randomization, ensuring no single entity will gain a monopoly over forging. The process is simplified for crypto exchange users, on such crypto exchange. On Kraken, for example, well says stacking is as easy as going to be stacking page, specifying the amount you want to stake and hitting submit. This is everything. This is also, if you see my different videos, if you see the videos on my page where I talk about crypto stacking for Binance, it's very simple, it's super easy. You go on the page, in every exchange you say stacking, you select your coin, then they give you the offers on Binance for like 30 days, 60 days or 90 days stacking. You select which one you want, you select the amount of coin you want, you agree to the terms, you stack, and you start to making money the next day. So this is why I like stacking, because there's nothing to do. The only risk you have, you should only stack in the biggest coins that you have. For example, I stake in Cardano. Yes, the market is volatile and the price goes up and the price goes down, and that's normal and that will always happen. But I don't go and stack on Shiba, where for example it can be a rug pull, and having one of the wallet ensuring 50% of the Shiba Inu coins, then Cardano is a little bit safer, and it's also a long time project that I want to keep on earning for the money that I have invested in. So this is the stacking and why it's easier. Coins that you can stake. You can stake a whole lot of coins. You can stake Ethereum, you can stake Cardano that I'm doing, Solana, that was a good one if you were back at the beginning. The stacking rewards, so you earn an additional token. This is the big one, increasing your individual stash of tokens or coins. Stackers aren't guaranteed anything, as the process of forming new blocks and doing out reward is randomized, but stakers do earn interest, so to speak. Stacking is less resource intensive, as opposed to crypto mining. Stacking consumes far fewer resources, which may help you sleep at night. Plus, stacking is servicing the ecosystem by making tokens more rare. Stakers get voting rights and participation. You get once you stake, what they're meaning by this is like, you stake your coin, you have passive income no matter what. You don't need a mining ring, you don't need graphic cards, you don't need a powerful computer, you don't need none of that. You just put your money, it will work for you. You will get passive income every day at a certain percentage. You get voting rights, so you become part of the ecosystem because you're giving your coins to the ecosystem. They will allow you to take decisions, which decisions are made as a democracy. So they will let everybody that mines have a voice in what should the next be for the coin, so that they listen to the audience, which is amazing, and is something really good for the stacking world. And stacking can be an easy way to grow holding because you get passive income every day. So this is the stacking. What are the risks? Well, the crypto is volatile. The lockup periods, you cannot, you might be able to withdraw, but you have to, a penalty. But for example, for me, Ziliqua is the worst stacking experience I've ever had. Yes, it made you a lot of money, it made you a lot of coins, but when I wanted to unstake them, and I wanted to buy XCAD at $1.20 more or less, and I was like, okay, let me unstake my Ziliqua, and I put everything in XCAD. 14 days lockup period. I absolutely hated that. So for the 14 days I couldn't do anything, and XCAD price jumped from $1.20 to $3.50 in those 14 days. Therefore, I'm not touching Ziliqua anymore because the stacking is just ridiculous. You don't even are allowed to lose 1% of your holdings if you want to stake now. Yes, I would have done it immediately because I lost 3x on a coin that I really believe in, and I wanted to invest when it was still low. Then, there are the lockup periods, you have to pay fees, yes, but a very small percentage of fees. After we saw the stacking, let's go and look at what liquidity pool is. Well, what are liquidity pools? A liquidity pool is a crowdsourced pool of cryptocurrencies or tokens locked in a smart contract that is used to facilitate trades between the assets on a decentralized exchange. Instead of traditional markets of buyers and sellers, many decentralized finance platforms are automated market makers, which allow digital assets to be traded in an automatic and permissionless manner through the use of liquidity pool. The role of crypto liquidity pools in DeFi. Crypto liquidity pools play as an essential role in the centralized finance ecosystem, in particular when it comes to the centralized exchange. Liquidity pools are a mechanism by which users can pool their assets in a DEX smart contract to provide asset liquidity for traders to swap between currencies. Liquidity pools provide much needed liquidity, speed, and convenience to the DeFi ecosystem. Before automated market makers came into play, crypto market liquidity was a challenge for DEX on Ethereum. At the time, DEX were a new technology with a complicated interface, and the number of buyers and sellers was small, so it was difficult to find enough people willing to trade on a regular basis. AMMS fixed this problem of limited liquidity by creating liquidity pools and offering liquidity providers the incentive to supply these pools with assets, all without the need of a third-party middleman. The more assets in a pool and the more liquidity the pool has, the easiest trading becomes on this centralized exchange. What are crypto liquidity pools important? Why are they important? Any seasoned trader in traditional or crypto markets can tell you about the potential downside of entering a market with little liquidity. Whether it's a low-cap cryptocurrency or a penny stock, slippage will be a concern when trying to enter or exit any trade. Slippage is the difference between the expected price of a trade and the price at which is executed. Slippage is most common during periods of higher volatility and can also occur when a large crypto is executed, but there isn't enough volume to select price to maintain the bid-ask. So how do crypto liquidity pools work? An operational crypto liquidity pool must be designed in a way that incentivizes crypto liquidity providers to stake their assets in a pool. That's why most liquidity providers earn trading fees and crypto rewards from the exchange upon which they pool tokens. When a user supplies a pool with liquidity, the provider is often rewarded with liquidity provider tokens. LP tokens can be valued assets in their own right and can be used through the DeFi ecosystem in various capacities. Usually, a crypto liquidity provider receives LP tokens in proportion to the amount of liquidity that they have supplied to the pool. When a pool facilitates a trade, a fractional fee is proportionally distributed amongst the LP token holders. For the liquidity provider to get back the liquidity they contributed, their LP tokens must be destroyed. Liquidity pools maintain fair market values for the tokens they hold thanks to the AMM algorithms, which maintain the price of tokens relative to one another within any particular pool. Liquidity pools in which protocols may use algorithms that differ slightly. For example, Uniswap liquidity pools use a constant product formula to maintain price rotation, and many DEX platforms utilize a similar model. This algorithm helps ensure that a pool consistently provides crypto market liquidity by managing the cost and ratio of the corresponding token as the demand quantity increases. So it's quite a difficult, let's say, it's not difficult to understand, but once you get it, you understand what liquidity pool is. There's a lot of information, but you provide liquidity for the market, for the price, for the volatility, for everything that a coin needs to be supported. You don't want to do the trading. That's what provides the liquidity for a coin if you do the day trading. But this brings into that you don't need to do the day trading anymore. You just put your money into liquidity pools and you get rewarded for your money to make liquidity. You get rewarded your coin back, and you also get rewarded more LP tokens. So this is why. Then of course you can go and look into it more on Gemini.com, whether you want to learn farming and liquidity pools. By looking at this video, you understood what is the best, let's say, passive income that you want to make with your cryptos and so on. So that was the video for today, guys. Thank you very much for watching. If you did enjoy, leave a like, subscribe to the channel if you're new, and make sure to share with all your friends and leave a comment. Thank you very much, guys, and I see you all in the next video. Ciao!